Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning. I hope you had a great weekend. This is Peter Lewis and a warm welcome to my podcast Money Talk for Monday the 24th of April. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, President Joe Biden aims to sign an executive order in the coming weeks that will limit investment in key parts of China's economy by American businesses. The administration plans to take action around the time of the G7 summit, which is due to start in Japan on May the 19th. This latest move marks an escalation in the US economic campaign against China, with capital flows now in the crosshairs. Flash April composite PMIs from the US, the Eurozone and the UK all beat expectations in data released Friday. The US service sector expanded at the fastest pace since April 2022. Eurozone business activity expanded faster than expected in April, with the composite PMI rising to an 11-month high. UK economic activity accelerated at the fastest pace in a year. Meanwhile, in Japan, activity in the services sector hit the second highest level since October 2013. Chile's President Gabriel Boric said last week that he planned to nationalise the country's lithium industry. Chile is the world's second largest producer of the metal, which is crucial to car batteries and other green technologies. Under the plans, Chile will create a state-owned lithium company to develop Chile's lithium resources, and future lithium contracts would only be issued as public-private partnerships with state control. Investors are piling into ultra-short-term treasury bills to avoid getting caught up in the US debt ceiling drama. Surging demand has driven 1-month T-bill prices higher, and the divergence between 1-month and 3-month bills is the largest on record. Unless Congress lifts the legal limits for how much the government can borrow, the Treasury Department could be unable to raise more debts from as early as June or as late as September, affecting 3-month government debts which matures around that time. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Dickie Wong, Head of Research at Kingston Securities. With a view from mainland China is Shanghai-based independent economist Andy Scher. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks suffered their worst week since March the 10th, which was the week of the Silicon Valley Bank collapse, with the Nasdaq the biggest loser on the week. On Friday, in a quiet session, US shares ended the day slightly higher. Equities were held back by strong US flash PMI data, sending the odds of a Fed rate hike next week higher. The S&P 500 eked out a 0.1% gain to settle at 4,134. The Dow added 22 points, or 0.1% to end at 33,809. The Nasdaq Composite rose 0.1% to close at 12,072. For the week, the S&P 500 fell 0.1%. The Dow dropped 0.2% to snap a 4-week winning streak, but the Nasdaq saw the biggest decline, losing 0.4%. Hong Kong stocks fell after mainland Chinese investors withdrew their money from the market by the most in 9 weeks. The Hang Seng Index lost 321 points, or 1.6%, to close out Friday at 20,076, extending last week's pullback to 1.8%. The tech sector and electric vehicle makers led the declines amid concerns about deteriorating US-China relations and intensifying competition. The tech index slumped 3.1% Friday and was down 4.7% for the week. This morning, futures markets are pointing to further losses for the Hang Seng at the open of about 85 points, or 0.4%. On the mainland, China's CSI 300 index slumped 2% in its biggest daily slide since October. The Shanghai Composite Index fell by the same amount, ending Friday at 3,301. And that took the weekly decline to 1.1%, despite the release of stronger than expected Chinese growth figures on Tuesday. Elsewhere in the markets, natural gas, crude oil, gold and copper were all lower on the week as traders worried about economic growth. Brent crude oil was down 5.4% over the 5 trading days at $81.66 per barrel, wiping out all of the gains stemming from OPEC's surprise output cuts. Treasury yields and the US dollar ended the week higher. And you can get all the latest market movements on my daily blog, which is at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And it's time to welcome my Monday morning guests, Alex Wong, Director at Alex K.Y. Wong Asset Management, and also Dickie Wong, who is Head of Research at Kingston Securities. A very good morning to you both. China-US relations are deteriorating further with news that President Joe Biden aims to sign an executive order in the coming weeks that will limit investment in key parts of China's economy by American businesses. The administration plans to take action around the time of the G7 summit due to start in Japan on May the 19th. And the White House has asked South Korea to urge its chip makers not to fill any market gap in China if Beijing bans Micron from selling chips, according to the Financial Times this morning. The US made the request as South Korea's President Yoon prepares to travel to Washington for a state visit today. China this month launched a national security review into Micron, one of the three dominant players in the global DRAM memory chip markets, with South Korea's Samsung Electronics and SK Hynix. Alex, this doesn't seem to be a good development in terms of US-China relations and also investors' worries.
Yeah, of course, this is a really bad development, and you can see the reactions from the market. Actually, last week, selling into megatechs and even the chip makers in China actually accelerated and after the news breakout. So I think we probably will still be affected by this development, and people probably will not change their perceptions as easily. And then I think we probably may see continued outflow from the tech sectors in Hong Kong.
Is it easy for Chinese chip makers to sort of try and develop their own equipment to be able to build their own chips?
I think it will take years. It will not be that easy because first of all, they will need to do the entire process by themselves probably, and then they probably may not be easy to get key equipment from overseas suppliers. That would also slow down their overall development. So that is not easy. And even if they can, I think the capacity initially actually would be not enough to cater for China needs.
Dickie, how big a problem is this? How big a worry is this going to be for investors? Because we saw a slump, didn't we, in the chip makers in China on Friday, and also here in Hong Kong.
Well, obviously, the increasing tension between China and U.S. and also U.S. may impose new sanction on some of the chip makers. Manufacturing equipment may hurt the Chinese, semiconductor industry seriously. And also, we have to bear in mind, Japan also recently imposed its own restriction on some of the 20-something types of semiconductor manufacturing equipments. So U.S. now joining Japan to curb China's ability to make advanced chips. So this has remained a serious problem. Still, China may import, as I've just mentioned, manufacturing equipment from from other countries, including ASML. But obviously, they're facing increasing, tension and pressure. So this is not easy for semiconductor companies to do all the jobs, including some of the manufacturing equipment domestically. They're simply not available in mainland. So that's why money outflow from Stock Connect, people selling chipset companies stocks, semiconductor stocks last week, mainly driven by this concern.
It's been a bad week for Hong Kong stocks. They fell after mainland Chinese investors withdrew their money from the market by the most in 9 weeks. The Hang Seng lost 1.8% last week. The tech index, that was even worse. That was down around 4.5% last week. And the Hang Seng Index has fallen about 11.5% since hitting a peak on January the 27th. So what do you make of this decline?
I do see, on last Friday, money just simply outflow from Hong Kong through Stock Connect. You can see some of the chip makers company, and there's a very big outflow from the Stock Connect as well. So I would not say bottoming or it's the best time to put your money in. But in the longer term, I think they're fundamental-wise, they're still doing okay, but the share price probably not.
And why are Chinese and Hong Kong stocks slumping? What we've seen the CSI 300, it was down 2% Friday, the biggest decline since October. If you look at the Hang Seng, it's down about 11.5% from its peak in January. Alex, why are we seeing this slide?
This slide actually is caused by the tech sectors or private enterprises. I think people are not confident in the long run outlook for these sectors because, first of all, I think people interested in SOE right now for China. If you want to put money in China, I think people are more comfortable in putting money on SOEs. And then the potential sanctions by the U.S. actually is the latest catalyst on the sell-off. So I think the original outlook actually is already not good for P chips, and then this sanction actually accelerated the bearish sentiment. So that's why we are seeing the sell-off accelerated. And I think people actually are quite disappointed about the performance in April, because in the start of this month, actually people are quite bullish on the P chips because of the potential spin-off of Alibaba. But I think this already once again failed to sustain. So I think this price action also damaged the long-term confidence into investing into Chinese mega techs.
Dickie, what do you put it down towards? Why are we seeing this decline?
Well, actually, I totally agree with Alex, and moreover, we have to bear in mind, the Hong Kong's dollar was really weak, and also touched a few times of the lower band of its currency band, and these create some kind of problem. First of all, money keep outflow from Hong Kong. This is not a good sign. And also, when the currency touched the lower end and the liquidity, it's really sit below 50 billion, which is the lowest point since 008. In terms of the interest environment, it will also give a boost when the liquidity keep on falling. So there is a pressure for not only the HIBOR, but also probably most of the interest rates, including the banks. They may have to hike interest rate in the short term. They may or may not, but there's still some kind of fear that the interest rate will continue to go up because this is the mechanism of the currency peg in Hong Kong. So
interest rates have got to rise, haven't they? The local banks have got to raise the prime rates to offset this.
They may have to rise the prime rate, but I don't really expect that because still, eventually when the liquidity drops so low, at the level close to zero, the interest rate will go up immediately, and then the currency may turn stronger. But there's some kind of fear that eventually if the banks, no matter a smaller one or bigger one, if they have to hike the prime rate, and that will definitely give a big damage to some of the local property developers and actually other companies. So this is also one of the fear. But moreover, increasing tension between China and U.S. and also money outflow from the Stock Connect. So these also create pressure to the Hong Kong stock market.
Alex, do you see this this capital outflow, this capital flight from Hong Kong? Is it going to continue?
In the meantime, probably not, because we are seeing some surge in interest rate in Hong Kong. So that probably will limit the extent of the outflow. But that I think is worrying, because you are limiting the problem by a higher interest rate environment. So that is another
not good,
problem here. Yes, because this is related to interest rate. So when the interest rate is higher, then probably the funds will stay here, but just for the high interest rate. So that is already quite damaging to the market and business environment in Hong Kong.
And is capital leaving because of that differential between US and Hong Kong dollar rates? Is that what is driving it out, or is there a confidence issue as well?
I think, first of all, this is the interest rate issue, and then I think this is also a confidence issue in the recent development, because this low interest rate environment in Hong Kong actually has been quite persistent over the past few years. But the problem is we are seeing a sudden surge in interest rate, so that is meaning the outflow actually is getting more and more significant.
Dickie, what do you think? Do you think this is also a confidence issue? Do you see this persisting?
I do think so. On the other hand, yes, we all know, like, when there's some kind of interest rate difference, people may just exit the Hong Kong market, just sell the Hong Kong dollar and buy US dollars. That's no question asked. But I do agree with Alex. This is also like a confident issue as well, because of the tension between China and US, and also because of the recovery of the economy, no matter domestically in HongOng or in mainland China. Is simply not good enough. And also, moreover, some of the, restructuring of some of the companies, including like Alibaba and Tencent, and they may spin off some of the companies, already reflected that, on the market. But the fear that some of the investors, they are still decreasing their stake on some of the key index components, including Naspers is still selling Tencent, and Alibaba is still facing off selling pressure from one of its biggest shareholder in Japan. So this is remain cautious. That's why the sentiment in Hong Kong is not that good.
Alex, how much is the data, the economic data that we saw from China last week sort of weighing on the markets as well? Although it was quite good on the surface, wasn't it? When you look at things like GDP and retail sales, when you dig into it more, there seems to be a worrying lack of business confidence and investment into new markets and new businesses.
Probably would be another problem, because people probably reckon the recovery should be speedier. So and also the consumption level actually is a bit disappointing. I think that probably would be still a drag in the market, and because we were quite positive on the potential impact from the reopening, but I think people probably reckon the development actually is not that strong. But the good thing is that we could do have some encouragement from the trade data earlier. So that I think is a bit supportive. But the point is we do have some mixed feelings from recent sets of data. So probably people will still look at the next round of data to determine whether the recovery is strong enough.
Dickie, what did you make of the data last week? Encouraging on the surface, wasn't it? But what do you think overall?
Well, in terms of economic data rolled out last week from mainland China, there are actually better than expectations, including retail sales, including some of the PPI, CPI, and etc. And there's no inflationary pressure in China. But in terms of investment, fixed asset investment, and also employment market, especially for teenagers, then that's another story. Still very high for unemployment rates from youngster teenagers and college graduates. And second of all, the long holiday is coming. In mainland, bookings in China for trips abroad during this long holiday will continue to grow. But in terms of the actual numbers still far below pre-COVID levels. So this is another concern about why some of the duty-free companies, there's still share price still underperformed the overall market and seriously underperformed some of the well-known big names, including Louis Vuitton, MS, their share price hitting new high and new high and new high again, but not the local duty-free operators. And also already probably reflected that the recovery is not strong enough to boost the share price of the companies I've just mentioned. But obviously, some of the online travel operators they are actually in better shape.
Alex, let me ask you a bit about that point that Dickie just raised about the unemployment rates. The official rate 5.3%, but the unemployment rates, the youth unemployment rate, that's for those aged 16 to 24, is increased to 19.6%. That means almost 1 in 5 young people are out of work, close to a record high. And we heard the authorities on Friday. They were almost sort of saying that university graduates, the part of the problem was they were refusing to put aside their professional ambitions and take on manual labour, and that basically they should go and work on farms and in supermarkets. This is a big problem, and that isn't really the solution, is it?
There's a big problem. Of course. I think that this is a problem we talk about for more than 1 year already. So there's a mismatch, and expectations has been too high for many young people, I think. And of course, another point is if they live in cities, then probably their families actually are okay, so they can sit at homes, and also probably they could search for jobs like YouTubers and KOL. So that is also not counted in the statistics. So I think this problem actually will persist. And this is a problem we're facing in Hong Kong as well. So I think this is not just the problem that China is facing, but I think the solution actually will not be easy to get.
And this is a problem, Dickie, isn't it? And it's not great for President Xi's campaign to sort of redistribute a sort of wealth, a common prosperity campaign, when graduates can't get jobs.
Well, that's so obvious. So that's why you can see a very clear tendency that when we talk about the private sector or even the tech sector, Chinese government tends to support them in terms of give them a lot of the regulatory pressure like previously last 2 years. But it doesn't really help the situation at all, because even the regulatory pressure is eased, but some of the tech companies, they're just simply not willing to hire more youngsters or hire more people because the numbers are not in good shape. So that's why they're not willing to hire more people. But yes, Alex have just mentioned a clear point. Some of the youngsters, they are not willing to find a traditional job. They don't like to work for the manufacturing sector. They want to find a job maybe related to the new economy, internet, and so on. They want to be YouTuber and KOL. That's why they can earn fast money. But obviously, not every single person, they have the ability to do so. So this is why, and they're actually from middle class families. So they don't have to urge to find a job to support their family. Actually, their parents are supporting them. So this is another problem. Actually, it's also happening in Hong Kong.
Let me ask you about the US markets. We had the PMI, the flash PMI data from the US, much better than expected, actually, particularly on the services sector. Alex, it doesn't seem to be pointing to a recession, does it? If anything, it's pointing to sort of growth seems to be quite robust, maybe around 2%.
I think the outlook is a bit mixed, and data actually are mixed. So this is still quite data dependent. But the general perception is that we probably will still get one more rate hike, and then that's it. And right now the market actually is very earnings dependent. So we are seeing diverse reactions to earnings from different companies. So in the meantime, the index actually is getting locked within a narrow range. But I think the breakout probably will happen soon because people probably will change their perceptions about the interest rate outlook quite fast. I think probably entering into May, probably we will have a clearer direction. In the meantime, we are still seeing reactions day to day on latest earning results from different companies.
Dickie, do you see a recession coming in the US, or is the data looking quite good?
Well, although I'm not that bullish on the outlook of the U.S. stock market, I'm not bearish either. In terms of the economic data, I don't really see that recession is coming, especially when we talk about the private sector. And obviously, the tension between China and U.S., I have mentioned again and again, may hurt some of the earnings outlook of the U.S. companies, but not that significant, obviously. But we have to bear in mind, the confidence about the banking sector, the outlook of the banking sector remains some kind of concern. I do agree with Warren Buffett. I don't really see the risk of depositors, but I do think some kind of risk on the banking sector. So banking sector may still continue to outperform the overall bond market. And some of the tech sector, it depends. I think I don't really see so much upside, but remain in some kind of range trading pattern, and I don't really see so much downside because Federal Reserve probably will hike one more time, 25 basis points for the Fed fund, and that's it. So this will give some kind of a hope for the market as well.
Well, thank you both very much. You heard there Dickie Wong, who is Head of Research at Kingston Securities, Alex Wong, who is Director at Alex K.Y. Wong Asset Management. I'm joined now by Andy Sher, who is Shanghai-based independent economist. Good morning, Andy.
Good morning, Peter.
Let me ask you first of all about this latest news in the technology war between the US and China. It looks like, first of all, this is going to extend now to investment flows, the US looking at restricting investment flows into certain sectors. And also the Financial Times reporting this morning that the Biden administration is trying to get South Korea to encourage its largest chip makers, Samsung Electronics, SK Hynix, to not fill the gap if there's sanctions put by China onto Micron. This all seems to be a worrying escalation, doesn't it?
Yeah, I think that the US is trying to slow down China's technology development. Will lose the competitiveness in these sectors. So it's trying to get its allies to work together on these. But I know it's really I think that it's not going to work out eventually. What I have seen is that it appears that it's really focused the country's attention on breaking through these restrictions. I think there are a lot of people, and China has a lot of money. And if you think the Chinese just dumb, couldn't do that without foreigners, and I think that assumption is probably not robust.
So do you think China will ultimately be able to develop its own semiconductor industry? As the problem seems to be it doesn't have the equipment, does it, to manage, to manufacture the advanced chips? But could it develop its own equipment? Could it source that equipment domestically?
Yeah, it's developing its own equipment sector. But the issue is that it takes a long time because the supply chain, the components supply chain is very long. It's even if for one machine, it would require maybe 500 suppliers, and these suppliers are spread around. Like in Japan, Japanese still good at some precision components and so forth. So it's not just the equipment itself; it's you really need to pull in all the whole supply chain. So it takes time. It takes time, but it's this is basically it's basically time consuming. But if you put your mind to it, you can do it. China is big enough to do everything together at the same time.
Mm. And what do you make about this news of new controls on outbound US investment to China that the Biden administration is talking about imposing at around the time of the G7 summit later next month in Japan? What sort of impact will that have?
Well, like this semiconductor equipment thing, it could have an impact, but it just slows down China's development somewhat, but it's not likely to stop China. This is really about what happened to this commercial jet. China is developing the equivalent of Airbus and Boeing jet, and it looks like it's working, and it came through many JVs with many component suppliers. But obviously this JV process did help, but it doesn't mean that in the future China will be totally dependent on these JV suppliers, because Chinese technology level is really making some tremendous progress in the last 3 years, as far as I can tell, in terms of manufacturing process, in terms of like EV. It's like basically a generation of people after making things, looking at how the technology how technology works. What I see is that a whole generation have matured and can do a lot more. This is just what has happened to like infrastructure, to the earlier stage of development and so forth. Basically, you have a generation doing something, and first initially at downstream, and making things. Then you walk back upstream, and eventually you figure out how everything works. And what I see is that in the technology space, this is what's going on.
And what is the risk then that the global economy is just going to split into two blocks? It's a fear that the IMF has, or the World Bank has, doesn't it? That you're going to have this China-centric block and then this US-centric block, which will be very damaging to global growth, wouldn't it?
Yeah, basically we're moving towards two prices. But the issue is that we're going to have a G7 price, and we have a global South price, which comes from China. And you look at the EV. China now is making an EV. The BYD selling EV for about $11,000 and that goes for like over 200 miles, about 260 miles. And anywhere else you find something equivalent that will cost twice as much. Mm-hmm. So this is what we're talking about. It's clearly in the EV space, because the U.S. is using subsidy to encourage local production. But the end result is that the U.S. EV will cost twice as much as China's EV.
So this is going to be very damaging then for the global economy overall if that happens. And as you say, we're going to end up with dual sort of pricing structures for key products.
Yeah, I think eventually the G7 would obvious high price slows down growth and boosts inflation. So that's something I've been writing about. We're going to have a global South. We'll have a different potential growth rate, and I think it's probably around 5%. I think the G7 is likely headed towards zero growth and inflation. And
maybe into recession. Do you see the US slipping into recession?
Yeah, it is, but it's going to be a full employment recession. It's basically because the U.S. the global labor shortage is all around and is structural. So the recession has to come from profit margin going down and shrinkage in capital expenditure and some reduction in fiscal deficit. the demand reduction will probably come from these three sources. But labor has bargaining power because of the labor shortage. So wages will go up, and will try to catch up with inflation and some. So the central banks who are hoping that a mild recession will bring down inflation, they will be surprised.
So let me ask you then about China's economy. We had the GDP data last week. GDP grew 4.5% year on year. Retail sales were particularly strong, rising 10.6% year on year in March. What's your assessment after seeing that data?
Well, I think that the market thought it was stronger than expected, and the financial market doesn't make much sense in terms of predicting the economy. What I see is that I wrote at the beginning of the year that China would have 5% growth rate, but that 5% is quite weak because the base is very low after 3 years of a pandemic. The base is at least like a -8. So if you anything below that is kind of not even filling the hole. So -8 is from the last 3 years. You're adding the potential for this year. It's about 12 to 13%. So obviously growth rate is very very anemic compared to that, to what you could do against what you are doing. The reason is because Chinese households really lost income during the past 3 years, and the savings stock kind of declined. So they need to rebuild. This is a very important element in slowing down the recovery of the service sector. Then we have the property sector that is really just beginning to restructure. It takes a long time, many years, for the property sector to normalize. And these two factors are keeping Chinese economy below potential.
And the authorities seem to be quite worried, don't they, about the consumer sector? They don't seem to be satisfied that it's strong enough. You mentioned the reasons why.
Yeah, you have to wait for wages to rise, for people to recover their balance sheet, and it takes time. And there's no point of hurrying on.
Let me ask you about the unemployment rates. 5.3%, but the thing that stood out was the youth unemployment rate for those aged 16 to 24. It's 19.6%, almost 1 in 5 young people out of work. This is a huge problem for China, isn't it? And it doesn't seem to have a solution to it. It was basically on Friday blaming graduates for wanting to have professional jobs rather than taking on manual labour.
Why too many people going to college these days? Over 50%. China is a manufacturing economy that doesn't need a lot of college graduates. So everybody wants to be a financial guy or internet guy. Both bubbles have deflating. So and during the meantime, we have a severe shortage of manual labor, both factory level or the service sector. So we do have a mismatch, and it's an aspiration issue. So I don't know how this is going to work out. A lot of kids who couldn't pass the college exam, then they try again, and they get their mother to stay home to kind of cook for them, and so that they think that helps. So we have 2 people staying at home for many years because this kid wants to go to college.
So you think
if you fail a couple of times, maybe you get the message. Even half of the people go to college and you still fail a couple of times. Is it worth it?
So you think the government may be right then that, graduates have got to maybe for a while put aside their professional ambitions and be prepared to take on other jobs?
Yeah, but what are they doing? They're bidding down the entry-level white-collar jobs, bidding down the wages to $3,000, $4,000, basically not getting paid, compared to construction worker getting paid over $10,000,
Andy, it's always very good to talk to you. Thank you very much indeed. That's Andy Sher, Shanghai-based independent analyst. And you've been listening to Money Talk. If you want more information on any of the stories we've discussed today, please take a look at my daily newsletter, which you'll find at peterlewismoneytalk.substack.com. Tomorrow on the show, I'll be joined by Asian fund management industry consultant Stuart Allcroft, James Wong, who is Chief Executive Officer at Kingston Securities, and our US economics correspondent, writer and broadcaster Barry Wood. Thank you very much for listening this morning.
Money Talk